Today I mapped out two different places your capital can actually live. One is the route that most of us already know. It's the route your advisor shows you, the bank shows you, the route that you probably have learned. It's what you've been told to expect, and the risk that comes along with that, well, we'll dive into that too. The other is what's called the infinite banking concepts, a system built specifically to help your capital be in your control, not in somebody else's control. It allows you to take back the banking functions in your life. And then there's a third piece that almost no one talks about. One design variable that decides whether your capital stays in your control or quietly shifts over to somebody else's control. That's what we're gonna talk about. I've sat at many tables across from people who did everything they were told to do. They saved, they invested, they paid off debt, all on schedule. Yes, even on schedule. But yet they still seem to feel like they're one bad month away from starting over. And then I've sat across from other people who use the second model, the infinite banking concepts, and they've told me the exact opposite, that for the first time, their money feels like it's working for them and not the other way around. Let's start with the model that most people already live inside of. Here's the goal: save, then invest, then retire someday. Sounds pretty good, doesn't it? But watch what happens to your control along the way. Here's how it typically works. You see, you're gonna earn an income, you work, you get paid, that money goes into a savings, typically at a bank, where it's gonna earn little to no interest. I think all of you know that. From there, it moves into investments. A 401k is pretty common, a brokerage account for some of you, maybe 529 plans. Then it's invested for the future, but you don't control it. Then after that, what we're gonna do is we're gonna move over and we're going to pay off debt. You got the mortgage, you got the car loans, the credit cards, the student loans. The interest on all of these debts goes to somebody else. Then you move to building assets. You buy real estate, you invested dollars. But now they're all subject to market risk and probably taxes. And eventually you're gonna retire, you stop working and you start living off what's left. And then you hope it lasts, a lot of hope there, because if the market drops, if inflation rises, taxes change, health issues comes up, well, you might outlive your money. Now notice what's happening at every single step. Money flows out and you lose control at each one of these steps. Now to be fair, this model has its real perks, it really does. You save, you invest, you plan for retirement. It feels safe. But here's what it costs you. You see, you're gonna give up liquidity. You're gonna lose interest on all of those places where money is flowing out. And your investments, well, you're relying on banks, the markets, and advisors to do right by you, and well, you have no control over that system. And along the way, money's going to leak out at every step. You see, the bank's gonna keep most of the interest. They're gonna make the spread. Wall Street's gonna take their fees, whether you make money or lose money. And the government, well, your silent partner. Yep, the government's gonna step in and take a percentage every year of the gains you made in most cases. Your financial advisor, of course, they have to get paid as well. And then there's your mortgage, right? Well, the bank or the lender, they're gonna collect interest for the next 30 years. And in the beginning, they're gonna collect a lot of that up front. Now, nobody in that list is responsible for your whole financial picture. So the result is this: you work your entire life and you work your entire life for a future that you can't fully control. So here's the big question. What if there was a different way? What if you controlled the flow instead? Let me give you an example. So you and I go to work for 40 years, let's just pretend, okay? And over that period of time, we managed to save about $400,000, and we invest that $400,000 in our retirement accounts. Sounds like a win, doesn't it? You did what you were told. You contributed to the 401k, but now life happens. The roof needs to be replaced. The transmission goes on your car. You get hurt, and the medical bills show up because the health insurance wasn't quite as good as you thought it was. Where does the money come from? Well, if you're like most people, it's probably gonna have to be that $400,000 that you spent 40 years building. And every time you pull from it, you're not just losing dollars that you withdrew. That would be no big deal. You're losing every year of growth that those dollars would earn into the future and for the rest of your life. That's the real cost. It's an opportunity cost in the traditional model. It's not the savings that went wrong. It's that the moment you were actually needing the money, you were forced to choose between spending your future or going into debt to protect it. There's no third option. Does that sound about right? Because I'm pretty sure that's familiar to most every one of you. And if it does, you're not doing anything wrong. You're just operating inside of a model that was never designed to give you a third option in the first place. And that third option is, can your money earn for you while you still use it? Let's move on to a new way, the way that puts you in control of your money. This is where the infinite banking concepts comes in. The goal here is very simple: to put you back in control of your money instead of giving it away. And also to use it, to grow it, and to have it return to you. It's kind of like a boomerang. When you throw it, the goal is to have that boomerang come back to you. Well, the same thing for your money. Now listen, all of us at one point or another have allowed other people and other institutions to control our money. That's fine. But that's also why I created this YouTube channel, so that we don't keep making those mistakes over and over again. So do me a favor and make sure you click that button right there. It says subscribe. And also there's a little bell up top. Smash that bell so that you don't miss any future videos or lives that I put out. Now here's the flow. You earn income the same as you did before, but instead of scattering that money across bank accounts, brokerages, and a dozen other places, you direct it into your private banking system. Money goes into the whole life policy, and that is a specially designed whole life policy. And then you decide how much and when you want to keep making premium deposits into it. This is the core to the whole strategy, a whole life insurance policy from a mutually owned company that pays dividends. That is what keeps you in control of your money, and that is what allows your money to earn and grow uninterrupted. You control the access to the cash value. And it comes with something that I absolutely love, a death benefit. That's right, protection built in for your family. This is where the capital actually lives. It's not scattered across 5 institutions. It's working in one place that you fully control. Now from there, you're gonna use your money, you're gonna access your cash value. There's tax advantages, it's very tax efficient. And for whatever matters to you, that might be real estate, expanding your business or starting a business, education, emergencies, debt payoff, whatever the moment calls for. You're not asking a loan officer, you're not waiting for approvals, you're not waiting for permission or anything. You are in control. You are not liquidating an investment either at a bad time when the markets are down and then you got drawdown risk. All of that is gone. See, you decide when you need money and you decide how to use that money, and your money continues to work for you. Then here's the part most people never see coming. The money returns. You pay it back on whatever schedule you want. Thou with the money makes the rules. This is your money, you make the rules. And it actually makes you more. This is not the bank schedule, this is your schedule. The interest goes back into your policy, not to a bank. That builds wealth. Cash value grows tax deferred, your death benefit stays protected, and you're building a generational wealth that will be used by your family well after you're gone. Even while, at the same time, your capital is out working for you somewhere else. Eventually, you're going to retire on your terms. You create an income from your own system, not the other way around, and what's left becomes your legacy. You pass on wealth. You don't pass on debt. You create freedom for the people who come after you. Look at what that actually gives you. You keep control. It's tax efficient. You have liquidity, and whenever you need the money, it's there for you. The collateral, that's what matters. Death benefit protection, wealth that lasts, retirement on your own terms, a generational legacy. Notice something about that list? None of those came at the cost of another. That's the part most financial products can't do. Now, I'm not going to pretend that this is perfect. There's a real trade-off here. More control means more responsibility. This isn't set it and forget it. And if that's what you want, just continue with the traditional plan. You have to actually manage this because this is your own banking system. You have to act as if you are the bank. And banks, well, they don't just sit around and do nothing. Therefore, there is an element of you having to learn this system.
That's exactly why we created the Vault, the operating system for the infinite banking concept. It's a software platform that simplifies, organizes, and helps you manage your entire banking system. If you'd like to learn more, click the link in the description below.
So let's make this real instead of theoretical. Okay, let's just say you've got some debt, and let's call it credit card debt in the amount of $40,000. That would require you to make payments to the credit card companies every single month at whatever interest rate they charge, and most of them are over 20%. So let's just say you've got $40,000 in your private banking system inside this whole life policy. What we're going to do is we're going to take a loan from the whole life and we're going to pay off those credit cards. Then, most importantly, what we're going to do is we're going to take the interest payment you were making to the credit card company, whatever you were paying them, we're going to pay that back to your private banking system, back to the policy as a loan repayment. Now what happens is you've gotten rid of the debt. All $40,000 continues to earn uninterrupted because you didn't use your money, you used your cash value as collateral, and you took a loan from the insurance company's general fund. So you're making a spread just like a bank does. Now you continue to make the same payments you used to make, but now you make them back to yourself. You have become the bank. So therefore, if you were paying the credit cards 20%, you're now recapturing and recycling the same 20% you used to give away. Same opportunity, except for now your $40,000 continues to earn for you, continues to work for you while you've paid off a debt. Now, replace the debt for a business opportunity loan. Okay, replace the business opportunity loan for a piece of real estate you need a down payment on. You see, that's why it's called the infinite banking concepts. Your money can do anything it wants for you, and you can use it for all of your life events. Same opportunity, same $40,000, but a completely different outcome each time because of where your capital was sitting, not anything else. You changed one thing, and that was where your savings went first. So let's pause for a second. In the old way, your money has one job at a time. And every time life happens, you start over. In the new way, that same dollar can pay down debt, fund opportunities for you, but the original dollars continue to work for you, all without ever losing control of your money. And if you want to see how the wealthy actually play by a different set of rules and how you can play by those rules as well, scan that QR code right there on the screen or grab the link down below. Now here's the part that I promised you at the start, the variable that most people never think about. Here's the reality. A lot of people don't know how to design these policies correctly. And then another caveat is there are plenty of IUL agents out there pushing the infinite banking concepts, but they're packaging it in a very dangerous way that the IBC practitioners group will never ever approve. And it is definitely not in your favor. So what's the one thing that makes or breaks this entire strategy called the infinite banking concepts? It's high early cash value. That's the foundation of everything that it's built on. You have to design the policy correctly with high early cash value, and that access is what you need. You also need lower cost on loans, more flexibility, a policy that performs as it's supposed to, and the infinite banking concepts works in a way that it's actually designed to work. And if you look over here, if the policy is designed poorly, if it's just an off-the-shelf whole life, it's going to have low to no early cash value, limited to no access, higher costs for loans, limited flexibility, and a policy that might underperform because it was based on hypotheticals in the case of IULs. And the infinite banking concept simply doesn't work as it was expected to work. And it isn't the infinite banking concepts that failed, it is the design of the policy. Here's what it actually looks like in the real world. Low cash value in the early years, or surrender fees in the account of a IUL, possibilities of it becoming a modified endowment contract or a MEC, limited access and tax penalties, high fees or increasing cost of insurance fees as found in the IUL, or just poorly performing IUL designs that do not perform at the hypothetical rates that were shown. You see, you got to design these policies for high early cash value. In the right structure, that's what's going to matter. And it's going to be what matters for your goals, not the agent's commission. If these policies are designed correctly, it's going to reduce the agent's commission by 60 to 90%. Now, the agent isn't just foregoing that commission, they're designing the policy so that they actually get less in commission so that you get more in cash value. If it were an IUL, it's different. Yes, they can be designed, but you're always going to have surrender fees in those early years, which are going to inhibit how much money you could use. In an index universal life, not to go deep down this rabbit hole, but in those early years, you're going to have two numbers. You're going to have your cash value and you're going to have your cash surrender value. Please know the cash surrender value is the only number you can use. And that is why index universal life does not work for this. Not only that, they have a rising cost of insurance. So the longer the time goes on and the older you get, the more expensive it gets. Whole life has a level cost of insurance, a guaranteed interest rate, and then you get paid dividends. It's a more consistent growth pattern and it's very predictable. Ask whoever's showing you the policy, ask them these three questions, ask them out loud and watch how they answer. Number one, what's my cash value in the first year and what percentage of my premium deposit does that represent? If it's close to zero or less than 60%, that's a red flag. Question number two, is this a specially designed whole life insurance policy from a mutually owned company? Or does it have some type of an indexed feature, like an indexed universal life, or a variable component? If they hesitate or start talking about caps or participation rates or mention index universal life or IUL or VUL, it is not the tool I've been describing today. And number three, ask them to walk you through what happens to my cash value and my death benefit if I take a loan and don't repay it right away. If they can't answer that clearly, then that tells you they don't fully understand what they're actually selling you, and they probably don't understand the infinite banking concepts. I've seen people hand over tens of thousands of dollars in premium deposits and put them into policies that were never going to work the way that you were told they were going to work, simply because nobody asked those three questions on day one. But let's talk a little bit about a MEC, because this is another risk. A modified endowment contract isn't something that happens to you. It happens because your policy is overfunded relative to how it was designed. And once you cross that line, once your policy becomes a MEC, you can't uncross it. It's permanent. That policy permanently loses the tax treatment that made it worth having it in the first place. Listen, if some of you have short-term goals, like 1 to 5 years, then the traditional model might work for you. If you want maximum market growth potential in the early years, great, this might not work for you. And if you don't need access to your money and you prefer to set it and forget it, that approach, well, the traditional model might work. If you're comfortable with market risk and volatility, the traditional model might generally be the right fit. And if you're not saving or able to save, well, I don't know what to tell you. Here's why understanding this matters no matter which path you choose. Where it goes, how it grows, what it becomes, your future is built on today's financial decisions. Understand your path, or somebody else is going to choose it for you. So make the choice. Create versus conform. That's what I always say. So here's the bottom line. There are multiple paths to financial freedom. Choose the one that puts you in control, and always consult with your financial advisor or invite them on a call with us so we can talk through this. You see, the old way, every dollar does one job and then it disappears. And the new way, that same dollar can do more than one job and it stays under your control the entire time. And whichever model fits your season of life, the one thing that actually breaks infinite banking concepts isn't the concept, it's the policy that wasn't designed properly, or the person using it fails to continue using the infinite banking concepts. And if you're ready to see how this works for your specific situation, well then book a call with us, just like it shows on the screen. And we're gonna walk you through that. Or guess what? Just give us a call. 866-329-BYOB. Or worst case, just stay around the campfire, keep watching videos, because the next video right here is gonna break down exactly how this works in detail. This is just the beginning of you taking back control of your money and you becoming your own bank.